Good afternoon and welcome to the Conduit Holdings Limited investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Trevor Carvey. Good afternoon to you, sir.
Thanks very much, and welcome to everybody. My name's Trevor Carvey, CEO of Conduit Holdings, and I'm joined by Elaine Whelan, our CFO. So what we've got here is the interim results deck, which we're going to walk you through. This is as we've shared with the market earlier today, and then I think we're going to move from thereafter into Q&A. So thanks very much, and let's move on. Next slide. And again, that's a disclaimer. Thanks. That's fine. Yes. So for us, 2024 interim results, comprehensive income of 98.1 million, and a gross premium written plus 36.1% to 737.8 million. Those two numbers are good, solid results for us as a business. So our 6 months results. The market has remained pretty much in our favour through the course of the first 6 months of this year. We've got disclosures here and slides around the individual divisions of property, casualty, and specialty. And there's some interesting moving parts, if you like, and some interesting detail within each of those. But overall, really pleased with that result. We've shown good growth, as I say, to 737 million over the same period. On the combined ratio, discounted combined ratio, 75.1. That compares with 72.5 for the first 6 months of 2023. We've got some commentary around that, and myself and Elaine will go into some of the moving parts within there. But it shows that even though there wasn't a particularly significant industry event, should we say, in terms of a US landfalling hurricane or very large natural perils event, there's still a lot of activity out there in the world in terms of smaller natural perils events, but also some of what we would refer to as man-made events, and in this case, events such as the Baltimore Bridge event, which happened in the half year. Comprehensive income, as I've said, 98.1 million, and a return on equity of 9.9%. Pleasing numbers, and that's up over the previous comparable period in 2023, was 9.1% ROE and a comprehensive income of 78.6. Elaine can give you a walkthrough of some of the moving parts within that when we come to the slide later on financial highlights. Some other high-level in the half year and market conditions that we've got. Probably best if I address those within the context of the next slides that are coming up, where we talk about property, casualty, and specialty in each one in isolation. So next slide. I'm going to read it from the slide here. It's pretty small on my screen, so excuse me. Yeah, so overall, gross premiums written, as I said, up 36%. And the bars on the right will show where that growth has come from across property, casualty, and specialty. You can see that we're still showing a good footprint across all three of those divisions. We have called out probably well over a year ago now that property and specialty were the areas where we saw the best margin and the best place to be deploying and skewing our capacity towards, and that's really what you're seeing there. So that growth has been largely generated through the property and specialty divisions. Come on to those specifically in a moment. Point around risk selection is absolutely key for us. Risk selection in terms of the broad portfolio risk that we get shown is the way that we really add the value to the portfolio. We have a very broad footprint across all three classes, access globally through broker intermediaries, and Bermuda still remains a very sound place to be transacting business and accessing business on the global stage for reinsurance. So for us, we still have a very selective risk approach. So we aim still to create a very broad funnel of distribution, distill those risks down into our portfolio and our analytics, and from there we create the portfolio that is balanced and diversified across different regions and geography. Last point there, really around the expenses, other operating expenses as we refer to them, and that trend line down from the high in 21 when we set up and incurring those build out costs, which are perfectly natural in a startup business, of north of 28%. Now trending down to that level in the 5 to 4, high 4 range, which really is just a function of us scaling the business and being able to disseminate that cost more efficiently across the earned premium base. We are in a position where, to a large extent, the business has been scaling for a while anyway. As you can see, over 22, 3, and 4, we're currently a headcount of 61 here in Bermuda, full-time employees, and it is the one location. So we made many comments previously around the way that we manage the business and the way that it's driven and controlled from centrally and within the one location here, particularly around that risk selection piece. It does aid our ability to spot trends, act on those, and deploy capital and capacity into the classes that we see where those greatest margins. So in one location, and we still believe it's a great way to go to market in accessing general reinsurance business. Next slide. So on the in the property arena, good growth, 43% in the half year. The growth that we've seen has come still predominantly from what we would call our ground up quota share business. That quota share business is where we're sitting behind those original insurance carriers, sharing in those original risks that are being written and reviewing those portfolios and tracking cycles alongside those existing insurance carriers. So it's where we're partnering up with them. Big area for growth that we've seen, that we've allocated specific capacity to, is in the US market in what's called the non-admitted space. And bear with me for a moment here, but that non-admitted space is basically where insurance companies operating typically on a state-by-state basis are able to fully control their price and their policy wordings in a free, open market way, shall we say. There is another class of business in the States which is called admitted, which is more regulated by the state, and that's where the state will, in many cases, limit and cap the degree to which insurance companies can increase rate, for instance, increase price. Our focus in growing this property book, where we've grown that quota share, is in areas like the States, where that non-admitted market has been really strong, has shown really good rate over the course of the last 4 years, and has been a good growth area for us. We do, of course, write excessive loss. So excessive loss inherently is the part of the industry that really takes care of more volatility. So much lower, like normal or expected loss ratios through less active cycles. But when hurricanes or earthquakes or large natural perils events, it's the excessive loss account which is really picking up more exposure to those type of events. We're in that space. We balance it within the overall portfolio, but what happens there at this point of the cycle is that it's generally a less desirable place to be skewed towards. So for us, rates have come off slightly year over year, particularly in parts of the US, and we still maintained a position, but it's less of a driver for our portfolio. Rate change, we're seeing 3% risk-adjusted rate change net of inflation. So that's the, if you like, the net impact that we see by the time that we overlay the impact of claims inflation and other factors on the pure rate that we get. That 3% looks like a relatively low figure, but it's coming on the back of very significant compounding increases over the course of the last 4 years, really, since Conduit came into inception in 21. So still in a really good place with really good margin, and it's a good place to still be deploying capital. Undiscounted combined ratio there, 61.9 in 23 up to 64.7. We've got some comments around that as regards some of the loss events. But in the main, as I said in the opening remarks, whilst there plainly hasn't been one single large major property event, it has actually been a pretty active year globally for smaller style wind and even flood events. Floods in Germany being an example of that. So in that context, still a good performance, still really pleased with it, but it just shows that, you know, property trends and loss ratios move, not just based on large headline events that you see in the press. Next slide. Casualty, commented on this at the start. Yes, we've grown, but 5%. And we're comfortable with that. You know, the portfolio has been very selective from day one. We have an enormous funnel of business that flows through in casualty. We're very selective in how we've supported the underlying carriers. And the portfolio has grown with them. So we've added some new contracts to it in the course of the 6 months, but generally that growth is really reflecting what the underlying clients are doing with their business. And that goes to the heart of casualty. Plainly, there's lower margins that we price in the casualty space, and we expect in the casualty space. That's just the nature of where that market is at the moment. It's still a good contributor to what we do. But the clients that we're supporting are also taking action. So, you know, if they're seeing the underlying policy conditions or terms weakening, then they take action and they reduce their exposure to it. That's what we look for in our client base. So casualty overall is, as a class, the comment I would say around the market conditions, it's really underpinned by not so much the global, but certainly country by country, the underlying inflation that sits within there, you know, be that in the UK or be that in the US or in parts of Europe. Inflation has obviously been a big factor for everybody. That claims inflation flows through into a way that recoveries and policies settle ultimately. And as that trend in claims moves higher, that's what's underpinning the premiums within the class. Interestingly, in the quarter, we actually saw a 2% risk-adjusted rate change, a rate reduction in casualty, and that's on the policies that we've written. But in the main, it's kind of been oscillating around that kind of +1, +2, flat, -1, -2. And it's really showing that in the main, what we're seeing is that the underlying rate that we're getting is pretty much plus or minus keeping in line with, or at least coping with, the underlying claims inflation. So very happy with what we've produced as a portfolio. It's a great balance to what we do elsewhere in the property and specialty space, and the client base that we've got there is doing a really good job in underwriting those risks through for us. Next slide. Specialty, yeah, big growth, 59% in specialty, coming from a lower base, 93 million, as opposed to particularly property. But as we flagged up before, a number of the specialty areas have shown really good margin for us. The areas that we have bound into the portfolio are essentially complementary to property and casualty. So one of the key features for us in writing the specialty lines of business is that we're not adding large amounts of natural catastrophe exposure, natural perils to the overall property book. I think it's true to say out there in the industry, it would be fairly simple to write and increase the specialty book, but it very often will bring significant increases in natural perils exposure. That's not what we're doing here. The specialty book for us is particularly valuable around what we call the non-catastrophe piece, the risk piece, and is currently pricing up pretty well in the main. The uptick in loss ratio in the half year from 80.7 to, sorry, combined ratio from 80.7 to 95.7 miles ago. Part of that is driven by the Baltimore Bridge. Obviously, an event which has been across the news screens, at least it was when it occurred a few months ago. We've provided for an ultimate estimate after reinstatements and net of reinsurance of $19.8 million, that is, isn't it? $19.8 million. It's a loss event which is, in our view, going to be very significant in the context of the marine industry, because whilst it was a bridge, obviously, that was demolished, almost certainly the vessel and the vessel owners and the vessel's managers will have a degree of liability there. That's the contract exposure that falls into the specialty class globally, and that marine and marine liability could potentially be a very large event by the time it works its way through the courts, etc. So we're aware of the limits that are out there in the market that can be called upon, and we've very much weighted our ultimate estimate of 19.8 million with those limits in mind. And that's, again, as I said, one of the drivers of the increase in the undiscounted combined ratio over the half year. Okay, next slide. I think we're moving on to financial highlights.
Yep, I'll pick up on some of these numbers here. Trevor's talked through a few of them already, but just to reiterate where I think it's important to do so. Gross premiums written of $737.8 million. That's 36.1% up in the prior year. And as Trevor's talked through, that's in line with the strategy that we had, which was a growth strategy anyway, but also taking advantage of the market conditions that we had in front of us. We've still had a fairly strong lean towards quota share, which Trevor touched on as well. And where we front loaded the book last half year, I think we've done that a little bit more this year, even again, given the opportunities that we've seen in front of us. So for the full year, we would expect that growth percentage to moderate a little bit, but still expecting strong growth for the full year. And that filters through into reinsurance revenue, which under our IFRS 17 reporting is essentially our gross premiums earned less our cedings commission. So it's a lower number, but it's due to the offset of that ceding commission in there. Our net reinsurance revenue then shows the offset of our ceded reinsurance expenses, which were a little bit higher this year than last year, and that's in line with the inwards book and the growth that we had in that book, plus a little bit of price increase at 1/1. But overall increase in the net reinsurance revenue there of 39.3%. Trevor's mentioned a little bit about the loss environment, and it has been another half year with a fair bit of activity that there was last year too, but more in the kind of mid-sized cats and man-made losses this year that we would expect to pick something up on. So when we do look at our undiscounted loss ratio, which isn't on this page but is in our press release, it's 73% for this half year versus 68.1% for last half year, versus a discounted loss ratio of 62.4% for this half year versus 57.5% for last half year. When we look at those kind of loss activity that we've seen year on year, when we back those out, our underlying is pretty much in line. So there's nothing really in there that we would call out individually. One thing that I do like to point out, 3.5 years into our business, is that we are still building up our reserve position and hopefully doing that with a fair bit of prudence in there. So that has an impact in terms of how we look at our loss ratios there. Expense ratios, as Trevor mentioned, have generally been trending down, and that's on the reinsurance operating expense ratio as well as the other operating expense ratio. So overall, our undiscounted combined ratio for the half year of 85.7% versus 83.1% for last half year. And on a discounted basis, that's 75.1% this half year versus 72.5% for the last half year. Comprehensive income, Trevor mentioned that as well, 98.1 million for the half year. That's up almost 25% on the prior year, and a return on equity for the half year of 9.9%. So echoing the comments there, and in terms of being very happy with those results through another active first half year. Next slide, please. On investments, overall return for the half year 1.5% this half year versus 2.1% last year. Our book yield is now sitting at 4.1% this half year versus 3.2% at June 30 last year. So we are generally seeing a higher yielding portfolio, so a higher return from that. Last year saw a little bit of a benefit from spread compression as well, so slightly higher return through the half year last year. But not really much change in terms of how we think about our investment portfolio. It's still pretty short duration, very focused on maintaining a high quality, highly liquid portfolio. Duration, we are nudging that very gently up towards the duration of our reserves. So we're currently at 2.5 years on the asset side versus 3.1 on the liability side. And we've been deliberately short the liability duration over the last few years while we've been going through the interest rate hiking cycle. Just as I said, nudging that up a little bit now. Asset allocation, really in line with where we've been previously, just nudged up a little bit, which is really just time in terms of some cash flow expectations. But other than that, no real changes from the prior quarter. Next slide, please.
Okay, yeah, thanks, Elaine. So just in conclusion, final slide. Number of these points we've covered already, but the headline and the point around multi-line reinsurance platform, multi-line strategy is a key one to bring out. Right from day one, when we're building the team and the strategy around building a balanced portfolio, we were at pains to make sure that the expertise that we put into the business comes from a big part of the insurance market. Often you see reinsurance platforms created, particularly around some of the property areas where it's kind of almost like a top-down approach, where cat modelling and high-level metrics are used to generate a view of the industry. Our view is completely divergent from that, in that having the insurance practitioners and a lot of insurance experience in a reinsurance company means that you can more confidently engage with clients, understand the cycle, market movements, and it's hard work, it's hard yards doing that in a number of cases, but it's the way that you really build into the business a sense of where the market is within these multi-lines at any one point in time. And that's really key for us. You know, we talk about positive market environment, and rate increases have slowed, and in some of the classes have indeed gone to negative. But we track those all individually. The portfolio is built with that in mind, and I think it's safe to say, and we've said this before, that when we put the portfolio together quarter to quarter, year to year, the way in which it's built and the way in which it's optimized as we progress is really key. Since we started the business, we've written over $2.6 billion in written premium. And when you consider that we probably within each of our property, casualty and specialty divisions have more than a dozen subclasses, you can see that there's a lot of moving parts where we're constantly looking at where they sit in relation to each other and how they complement each other when we fold that through into our sort of balanced position that we're looking to create. And that's a big part of the model, a big part of what we do. Rate environment generally at the moment is still positive. As I say, a bit of a transitionary phase in some of the classes, but overall, it's still a very good place to be deploying and underwriting into. And for us, having a clean capital base, without the hangover, should we say, of back year legacy. So it's still being reported, obviously, in the broader industry, even in the reporting season that we're in now. There's still some back year adverse claims being experienced in the industry in the casualty lines, going back to pretty much pre 2020. And we're seeing that we're not encumbered by that. and for us that's really important, and it helps us to be able to still to continue to deploy a clean balance sheet into the market that we're now in. So very pleased with life in terms of the way it's presenting itself to us, and I think we still have some good times ahead in terms of this year and beyond. So happy to move to Q&A.
Perfect. Trevor, Elaine, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. We have received questions, so we'll dive straight in with the first one here, which reads as follows. Given the forecast of an unusually active hurricane season, how much of that is priced in, and how concerned is management of the potential impact of the active hurricane season on loss ratios?
Okay, yeah, I'll take that. Yeah, in terms of pricing in a hurricane season or a hurricane experience, in the main, when the wind exposed business, let's call it that, is priced year on year, it does have a small weighting in some cases towards the season that's forecast, but usually in this industry not. So it's very unusual that we would take a client's submission to us, look at it and price it from a hurricane standpoint, and then adjust it for the forecasts which apparently are out there this year. In terms of the industry and correlation, one of the important points around the hurricane season is, I think it is acknowledged that climate change, sea surface temperatures, etc., having an impact on the frequency and the severity of the business. But in terms of the hurricane impact, but there's generally quite a weak correlation between the frequency of hurricanes and the actual insured loss. If you go back over time, go back certainly over 2 or 3 decades, that hurricane has to make landfall in a place where insured values are material. So yes, while it may well be a forecast that's out there saying the industry may expect a more active year, there's not a strong correlation between the actual finally insured loss. In terms of where we are, we make provision for not just hurricane, but other large events and other large natural perils events within our pricing picks. That's provided for, and that's tested and stress tested, but it's certainly tested back against the portfolio and in terms of sort of general market experience and client experience. So we shall see what the next few months bring, but overall we have a very solid position, and I think, as we've mentioned before, we also have a protection program, should we call it that sits around large events within the business, and we have a degree of ability to lay off or hedge large events if they do impact on the portfolio.
I think also just in terms of how we risk select, we are quite careful about making sure that there's balance within the book and managing volatility. The tail risk in our PML exposure is probably at the lower end of peer companies.
That's great. Thank you very much. Turning to the next question, what is Conduit Holdings' unique competitive advantage versus other listed P&C reinsurers?
Okay. The one that I've always cited here, and the one that I think becomes more apparent with every year that goes by for us, is the ability to use the insurance knowledge from the ground up to engage with the broader client base. So I said earlier that the expertise that we've got is heavily grounded in the insurance market, and to be able to assimilate data in from hundreds of clients from the insurance side, bring that into our portfolio, spot trends within there, and then discuss that back and play that back with clients is really valuable. It's a bottom-up approach. So when we're doing that, excuse me, turn the volume down. When we're doing that and engaging with clients in that insurance space, I wouldn't say it's unique, but it's certainly a way and a strategy of dealing with risk that's being assimilated, which is different to a lot of other companies. What we've seen is within the portfolio that we've bound during the last, or written in the last 12 months, and certainly seen risks which are more varied and more broad in nature. So maybe they have some specialty and some property in there. Those are risks which there's less markets around that can assimilate those risks and underwrite them. We've got a collection of individuals in one location that can bring their resources to bear on that risk, engage with actuarial that's sitting in this one location, and feedback and work with clients to find a solution that works for both of us. That is not normal in the industry. In the industry, it's much more likely that reinsurers have a silo approach. There's a property unit and there's a casualty unit, and sometimes they'll be sitting in completely different parts of the world. And that is a big advantage in being able to negotiate with clients and strike a balance on contracts that work for both parties. So long-winded answer, so apologies for that, but that is, to my mind, the strongest differentiator that we have.
That's great. Thank you very much. How does the underwriting risk appetite compare with peers?
Tough to comment on the peers. From a capital standpoint, there are obviously larger entities out there, which presumably would have larger absolute appetites. But in terms of where we and how we gauge our risk appetite, in terms of the portfolio positions we take, for instance, as a percentage of tangible net asset value, we have a position there where we set our probable maximum loss and tolerances, I think, at very sensible levels. And by that I mean that, we have exposure to large events like the bridge, like hurricanes and earthquakes and the like. But we're always putting that exposure on the books, subject to an overall tolerance that keeps it what we believe in balance, and that is very important. So I think in that respect, we have probably a broader risk appetite across classes than other reinsurers because we want that diversification. But I would be proud to accept the fact that we have perhaps less of an appetite to any one large event that could imbalance the portfolio.
Perfect, Trevor. Thank you very much. Just turning to the next question. I think you have touched on it, but if you could maybe provide some more colour. It would seem that we might be in for a bad hurricane season. Does this concern you?
Well, my seaweed on the wall hasn't turned whatever colour it has at the moment. So, and that's the nature of these forecasts, as I've said. It doesn't concern me in terms of where we sit as a business. Perhaps if we were a standalone, unique, single-class property catastrophe reinsurer writing business, it would do, but that's not what we are. So I think we've got a robust portfolio where each deal is priced individually to bring a margin to the portfolio and create that's a greater degree of stability. So no, in the main, no, it doesn't concern me.
Could you expand a bit on what classes of business are included within casualty and specialty?
How long's a piece of string for them? Very broadly, within casualty and specialty, we would have, as I say, probably about a dozen main classes. As examples, in casualty, you could have professional liability, so liability to professions, architects, engineers, the like, doctors. Management liability, which is essentially the same. D&O, so directors and officers, so liability of directors and officers. General liability, which would be the liability of corporations to mis-selling of products, or indeed an event that could happen to them within their sort of corporate environment. Railroads, for instance, railroads buy large amounts of cover to cover themselves against causing damage to third party or to bodily injury to the general public. So casualty classes are in that, and those are the main ones. Probably for us, reasons I've cited those first, those are the ones that are more prevalent in our portfolio. We don't have a major exposure to medical liability or hospital liability, and that's a big part of the business. And also auto or motor, as we refer to in the UK, that's not something we write. And that often, if you're having broader definitions cited of casualty, would it probably include quite often motor liability. We don't write that class for various reasons I won't go into now, but we don't trade it in that class. Specialty for us falls into the marine, the energy, the aviation, renewable business, renewable structures, if you like, so wind turbines and the like. And then both the physical damage to those and the liability. So specialty kind of has a double up in the number of classes. A good example would be the bridge and the Baltimore loss. Specialty covers the vessel, which is damaged, so that's the damage to the vessel. It covers the cargo on the vessel, but then the underwriters in a separate policy cover the liability of the vessel. So specialty covers both first and third party, and is a fairly broad class in that. As a point, just to highlight, and we've said before, we don't write trade credit and we don't write mortgage business, which sits within the specialty arena. Sometimes it is a sizable cohort of specialty accounts, but we don't, primarily because it's correlated with the asset side of our balance sheet. So that's a bit of a highlight anyway in terms of some of the classes.
We do have in our year-end financial statements, in our risk disclosures, the description of the classes of business that we underwrite. So if you want to go to that as a reference after this presentation, then you'll find that there.
The next question is really around the dividend and asks, your interim dividend is unchanged. Is this an indication that the same might happen with the full year dividend?
I think we've been fairly consistent in our dividends so far. We don't like to commit too far into the future on that, given that we are an underwriting risk-taking business. But I think our interim and final is reasonably well understood at this stage.
Thank you very much, Elaine. The last question we've got here. I have read that the ILS market is raising considerable sums for catastrophe bonds. Is this likely to either increase Conduit's underwriting capacity or alternatively put pressure on rates or attachment levels?
Yeah, that's a good question. Bit of both. We obviously do. We are in the cat bond space currently, and benefit from the protection that that issuance provides for us. We'll keep that under review in terms of the scale to which we utilize the cat bond market. More capacity coming in has undoubtedly and almost certainly will suppress some of the spreads in that space. That does have a knock-on effect also, as you allude to, on the pricing of our inwards business and the business that we write. It tends to fall, though, in a kind of relatively limited area. The cat bond space likes the more remote risk, the more binary triggers, so tends to put capacity into the areas that respond to not many of the smaller risks, but the very large one-offs. That's not an area we really deploy a lot of capital into when we're writing a competing product to the cat bond market. We tend to operate in the area where kind of our insurance knowledge adds more value, and that's generally at the lower level that responds to a series of smaller claims, which the cat bond market is not particularly set up to accommodate effectively. So I don't think it has a major impact on what we have seen on our own property experience, and where certainly the majority of our premium exposure comes from. But it may offer us potentially more opportunity on the purchasing side.
That's great, Trevor, Elaine. Thank you very much for answering those questions you can from investors. Of course, the company can review all the questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to you both, Trevor, could I just ask you for a few closing comments?
Yes, thanks very much. Thanks for all coming online and listening to the presentation. We think it's fundamentally first a good set of numbers. and it's what the business was articulated to be able to do to generate return of this level. And in the market that we're in, it's as I said before, it's a good place to be and to be deploying. So thanks very much for being online, and look forward to speaking to you again at the next gathering, shall we call it?
Perfect. Trevor, Elaine, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Conduit Holdings Limited, we'd like to thank you for attending today's presentation, and good afternoon to you all.